which is our last chapter. But before I do that, I'd like to talk a little bit about the Great Recession. Not the Great Depression, but the Great Recession. Now, the Great Recession is the name given to our last economic downturn, which began around 2008, right? And it has ended, probably ended about, let's say, 2 years ago, okay? So this is the Great Recession. So let's discuss this event, okay? Now, I'm going to make this a little interactive. Can somebody give me a sense of what triggered this event? Anybody have a sense of what triggered the Great Recession? Yes, so there was something to do with the housing market, correct? So what exactly was going on here in the housing market in this period, which is the middle, or the first decade of this millennium? Well, what was happening was this. In those days, banks were giving out very easy, or rather, they were giving out mortgage loans very easily. Now, when you go for a mortgage, when you go to the bank to apply for a mortgage loan, do you know what the process is? What do you have to, what information do you need to provide the bank? Any sense? When you want to borrow money, let's say, to buy a home, a large sum of money, naturally, right? What questions would the bank ask you? Okay, so they're going to ask you about, well, they're going to look it up, rather, right? They will go and look at your credit score. Now, by the way, there is a course offered here in the, it's a finance course. It's called Personal Financial Management. And I believe it probably have a different name, but UTRGV is going to offer this course as well. And it's a useful course for really everyone to take, because it gives you a good sense of these practical matters. Okay. So everyone has a credit score, right? And I believe the highest the score can get is it's like a SAT score, 800, I believe, right? And so they're going to look up your credit score. What else? What other information will they need in order to process your loan application? Yes. So they are going to ask you for your income. And so you are going to have to provide them with, let's say, pay stubs. You may also have to provide them with a copy of your last year's tax returns. So this will give them a sense of how much money you make every year. Right? They will, of course, also send their own people to look at the house you're planning to buy, right? To make sure that it's a sound house. Because you see, they're afraid that if the house, if there's something fundamentally wrong with the house, like let's say a cracked foundation or something, which you didn't realize when you looked at the home, and you buy the home, and then there are these expensive repairs that will be necessary later on. The bank is afraid that at that point you may decide to default on your loan, simply walk away from the home, and the bank will be then stuck with this house, right? Okay. Now, back in 2008 or so, before that even, banks were not really scrutinizing people's credit scores, and neither were they looking at their incomes very carefully. It was very easy to get a large mortgage loan, even if you weren't earning a lot of money. Now, why was this? Well, what was happening back then was that home prices were rapidly rising. And lots of people believed that this was a trend that was going to continue. So the idea was, this is something the banks recognized and also the people borrowing money recognized, that you really didn't need high income to buy an expensive home. You could get a large loan, buy this expensive home that you really couldn't afford. You see, you couldn't make the monthly payments. But the point is that you could perhaps hang on to the home for a short period of time, maybe a year. If you could gather enough resources to make payments for just a year, by that time, the value of this home would have gone up, right? And you could then sell the home, repay the bank, what you owed the bank, and then come away with this large profit. You follow? Because home prices were rapidly rising. So banks recognize this as well. So if you approach the bank for a large loan, and they looked at your pay stub and you weren't really making a lot of income, they might still advance you that loan, knowing full well that there was very little risk that you would not pay them back, given that home prices were rising, right? You could easily then, at some point, sell the home for a large profit, have enough money to repay the bank, and then have, and keep something to yourself as well. Correct? So now, remember that this rising home prices, in a sense, then led to easy loans. And then the easy loans further fueled the rise in home prices. It's a bit of a circular thing going on there, you see? Right? You have rising home prices. On the strength of that, you can get loans easily. And then you go and buy these homes, and that further pushes up the price of homes. Remember that home prices are determined by the demand and supply of homes. So you need to think about a market for real estate, right? A traditional market. Here is the quantity of homes here. This would be the price of a home. You have a demand curve for homes and a supply curve of homes. Now, with these easy mortgage loans, what tends to happen is that this demand curve shifts to the right, because you can borrow money easily. So lots of people are buying homes, therefore, pushing up the price of homes. So this is a circular thing that's happening. You see, home prices rising, that makes loans easier in a sense. Banks are easily convinced that their money is safe. They lend you the money, you go with that money to buy homes, and that further pushes up the price of homes. Correct? But at some point, what happened was this stopped. This stopped. You see, there's only, the price of anything has at some point has to come back to its true price in some sense, right? So what happened then is that the housing bubble, so this was a bubble. What is a bubble? A financial bubble is basically when the price of the asset rises to some extraordinary level, which is completely far removed from the true value of the asset. Okay, so you have a housing bubble which then burst. Right? So now what happens to all those people who borrowed money to buy these expensive homes that they really couldn't afford? They bought the homes simply because they were expecting to sell them at profit. Right? But now they're stuck with these high payments. They don't have incomes that are high enough to enable them to make those high payments for too long, right? So then you have a spate of defaults. People start defaulting on their loans. So they basically tell the bank, you take up, foreclose on the home. Take it back. I can't make the payments. I'm just going to walk away from this home. Right? So what this really means is that banks are saddled with a lot of bad debt. This is money they're not going to get back now. So they're stuck with all these homes, whose prices, by the way, are now falling. Correct? So what happens to the way banks now start to think? What effect does this have on the desired reserve ratio? So we're coming back to course materials now. So what is the effect of this, do you think, on the desired reserve ratio of banks? Now, what's the desired reserve ratio again? It's the fraction of their customers' deposits the banks want to keep as cash, in other words, as reserves, in other words. So this is money that banks now don't want to lend. So a reluctance on the part of banks to lend would lead to a rise in their desired reserve ratio. Does that make sense? So what do you think happens to the desired reserve ratio of banks once they've made all these bad loans? You see, they were expecting to be repaid. So with all these bad loans, don't you think the banks are now running low on reserves? Right? So banks become a little worried about their liquidity position. So what they start to do now is they become reluctant to lend money. They want to build up their reserves, having lost all this money in these bad mortgage loans. Right? So the desired reserve ratio of banks starts to climb. Now, what is going to be the effect of this on the money market and the goods market? Well, when the desired reserve ratio of banks rises, what does that lead to? This, of course, leads to the money multiplier becoming what? Bigger or smaller? Do you remember the formula for the money multiplier? 1 plus C divided by R plus C, where R is the desired reserve ratio of banks. So if this starts to climb, that's part of the denominator of that expression, correct? So that would cause the entire multiplier then to decrease. Is that right? Okay, so we have a fall in the money multiplier. Okay, what's the effect on the money market? Well, is there any effect on the money supply with a fall in the money multiplier? Now, we've learned in class last time that the change in the money supply can be written as the monetary base times the change in the money multiplier. In fact, we did a little math problem involving this formula. Correct? So what's the change in the money multiplier? This, of course, is a negative change because the money multiplier is reducing in size, given that the desired reserve ratio of banks is rising. So with that being negative, what's the change in the money supply going to be? Well, the monetary base, of course, is a positive number. So positive times negative is going to be negative, right? So in other words, the money supply is falling as a result of the rise in banks' desired reserve ratio. Is that clear? Now, what does a fall in the money supply do to interest rates? Well, what happens to interest rates when the money supply falls? What diagram do we need here? We need the diagram for the money market. Do you remember the diagram for the money market? We have the money supply curve that's like this, and we have the money demand curve that's like that, correct? Quantity of money, rate of interest, right? And if the money supply decreases, that would be a shift leftward in the money supply curve. And that causes the interest rate to rise. So as a result of the money supply falling, we have a rise in the interest rate. And what is the effect of that on the goods market now? A rise in the interest rate causes consumption spending to fall, investment spending to fall, net exports to fall. In other words, aggregate demand falls. Is that right? Now, when aggregate demand falls, what happens to the recessionary gap? Increases. So this then triggers your Great Recession. So is that story understood then? Right? So this is a common explanation of how the bursting of the housing bubble led to the Great Recession. Right? In other words, when banks realized they made all these bad loans, they became reluctant to lend money to other people. You had a drying up of credit in the economy. And credit is very, very important for businesses to function. You follow me? So we have a big impact then on the goods market. Now, what did the Fed do when this happened? Action by the Fed. So when the Great Recession was triggered, what did the Fed do? In fact, the Fed only very recently stopped doing what it began back then. What the Fed began to do at this point is the Fed began to buy government bonds plus other securities from financial institutions. Now, would you describe this as such as banks? Now, when the Fed buys bonds, what is that called? Is that called an open market purchase? Yes? So in other words, what the Fed began was a large open market purchase. But remember, up to now, when I've been talking about these open market operations, I've always put myself, for instance, in the picture. As in, I have a bond and I sell it to the Fed, or I buy a bond from the Fed, right? So I've been talking about the Fed basically buying and selling bonds with the public, but now they're really doing it, they're buying bonds from banks. But the effect is really the same, if you think about it. When the Fed buys a bond from a bank, it gives the bank cash. It gives the bank monetary base. What happens to this cash? It ends up in the bank's vaults. It becomes, in other words, reserves of the bank. You see, after having made all these bad mortgage loans, banks were running low on reserves, you follow? Right? Because they were expecting to be repaid. But now they were not being repaid, so they were running low on reserves. This made them reluctant to lend. Right? But what the Fed did was the Fed began to buy bonds and other securities that banks possessed, thereby resupplying them with reserves, which banks could then start to lend. Right? So what this does is this increases banks' reserves, which means that banks start to lend once more. And of course, this leads to, as we've learned, this leads to the money supply rising, leads to the rate of interest falling. Yes? And once the rate of interest falls, we know that that causes aggregate demand to rise, and that would narrow any recessionary gap. So the Fed embarked on this large program then of security purchases from banks. And they weren't just buying bonds. They were buying any kind of security the banks possess. Banks often have company stock as well, you see. So they were buying from banks, not just government bonds. They were buying all kinds of securities from banks. Okay? So in chapter 17, we are going to deal with some details of this story here. Right? Okay? So let's start to talk about that. So we know how monetary policy is supposed to work in the face of a recession, right? The Fed is supposed to take action that will increase the money supply, because that is going to cause the interest rate to fall. And when the interest rate falls, this stimulates consumption spending, investment spending, as well as net exports. In other words, aggregate demand rises, And this causes equilibrium GDP to rise. And this really is the final aim, to increase equilibrium GDP, narrow recessionary gaps, reduce the unemployment rate, therefore. Correct? Now, how does the Fed know that it's doing this? Now, let me give you an analogy. Let's say you're driving your car. How do you know how fast you're going? You have an instrument, right? You have the speedometer that tells you how fast you're going. So the Fed, too, needs a kind of a gauge. It needs something to figure out whether it is, in fact, increasing the money supply. And what is that instrument? What is that gauge that tells the Fed it is, in fact, proceeding correctly and that it is, in fact, increasing the money supply? That particular instrument is something called the federal funds rate. The federal funds rate. Now, what is the federal funds rate? Federal funds rate is basically an interest rate that banks charge each other on short-term loans. Now, let me explain this a little better. Banks, when they are a little short on reserves, will often resort to borrowing money from each other. Now, I've mentioned before that they might borrow money from the Fed, right? But that would be a longer-term measure. If it's really short-term, like an overnight loan, for instance, banks will often borrow reserves from each other. And the interest rate involved in this borrowing is called the federal funds rate, right? So IBC Bank may, for instance, borrow money from Chase overnight, just for one night, and then repay the next day, right? And the interest rate charged by Chase, in this case, will be the federal funds rate. So in other words, you have a market. There is a market for reserves. And I'm going to draw the diagram for this market now. And it looks like this. Here we have the quantity of reserves. Here we have the federal funds rate, which, as I've said, is an interest rate. This is the demand for reserves, the RD curve in your book, demand for reserves by banks, and this is the supply of reserves. Now let's understand the RD curve, the demand curve for reserves. Why is it negatively sloped? Again, here we need to think of this as an opportunity cost to banks of holding reserves, because reserves earn them no interest. On the other hand, if they lend these reserves out to other banks, they earn some interest. Right? So if the federal funds rate is really high, this would make it expensive in an implicit cost sense for banks to hold on to reserves. Do you follow? It's the same argument for why the interest rate is a measure of the cost to us, the public, of holding money, because money earns no interest. Correct? So the higher the federal funds rate, the more reluctant banks are going to be to hold large quantities of non-interest earning reserves, right? That's why the higher the federal funds rate, the lower the quantity demanded of reserves by banks, right? On the other hand, if the federal funds rate is low, then the implicit cost of holding these reserves is low for banks, and so banks will be willing to hold larger quantities of reserves. So that's why the demand for reserves curve is negatively sloped. And then we have the RS curve, the supply of reserves curve. And this is controlled by the Fed. How? How can the Fed, for instance, raise the supply of reserves? Banks' supply of reserves, that is. Well, we looked at this in our previous slide, if you recall. If the Fed buys securities from banks, this will lead to a rise in banks' reserves. Am I correct? So the supply of reserves would rise if the Fed bought government bonds and other securities from banks. Right? So how is the Fed going to raise the supply of reserves then in the next slide? The Fed does this by buying, or for that matter, selling securities. Buying them from banks, selling them to banks, for instance. So if the Fed wishes to increase the supply of reserves, what would the Fed do? The Fed would buy securities from banks. This would provide banks with monetary base, more reserves. Is that correct? So this vertical line, the RS curve, could be made to shift to the right like this. Could be made to shift to the right like this if the Fed started buying securities from banks. Now, what would that do to the equilibrium federal funds rate? This is a market, after all, which comes to equilibrium. Equilibrium happens where the two curves, the supply curve and the demand curves, intersect. So this used to be the old equilibrium federal funds rate. I'm going to call that F star. What will be the new federal funds rate? Well, there will be a new equilibrium here. And this will translate to a lower federal funds rate. Correct? This, as I said, is like the speedometer. This is what the Fed keeps an eye on, because once the Fed sees the federal funds rates falling, it knows what? What does it know? It knows that banks' reserves have increased, correct? Right? So when F star falls, this of course indicates to the Fed that banks' reserves are rising, correct? Now, the Fed knows that when banks' reserves rise, what do banks do with their reserves? With their excess reserves, that is? They start to lend. Am I correct? So this is the Fed knows that banks will certainly increase their lending. Right? And this, the Fed knows, should raise the money supply. Correct? So the Fed keeps an eye on the federal funds rate. That is its speedometer in a sense. It knows how fast it's moving for it by looking at that dial. That's I think, a reasonable analogy. Right? Because a fall in the federal funds rate indicates that banks' reserves are rising. And the Fed knows that with rising reserves, banks will start to lend again. They'll start to increase their lending. And we know that when banks increase their lending, the money supply increases. Is that completely clear to you? Why would bank lending cause the money supply to increase? We've discussed this in class, right? You lend the money, you go and spend the money in Best Buy, the money ends up in Best Buy's bank account. Am I right? And that causes the sum total of the nation's checkable deposits to grow, hence money supply to grow. Right? So we know that bank lending causes the money supply to increase. Is that understood? So this is how our Fed approaches monetary policy. It keeps an eye on the federal funds rate. This is its gauge, its indicator of what's happening to money supply, right? So if the Fed wishes to increase the money supply, it will start to buy securities from banks, and it will, of course, while doing this, it'll keep an eye on the federal funds rate. If it sees the federal funds rate falling, then it knows that its expansionary monetary policy is in fact working, right? Now, when the Fed takes action, it must maintain a certain balance between unemployment and inflation. Let's talk about this now. Not just the Fed, even the government when it pursues fiscal policy. A certain balance between unemployment and inflation has to be maintained. Why? Because there is a trade-off between these two. Now, what's meant by a trade-off? That means when you reduce unemployment, you may end up with higher inflation, right? Or, conversely, if you tackle inflation, if you start to reduce the rate of inflation, you may end up with higher unemployment. So let's understand this. There are two good things, two desirables, and that is low unemployment, and the other good thing is low inflation. They're both desirable. But it seems that we can't have both. If we choose one, we have to give up on the other, right? And let me talk about that a little bit now before I stop here today. What is the nature of this trade-off between unemployment and inflation? And it really all boils down to the diagram for the goods market. Real GDP, Y, the price level, P, aggregate demand, and aggregate supply, correct? So let's say that currently the economy is in recession, meaning that this equilibrium GDP is less than full employment GDP. So this is our recessionary gap. Now, typically, when there is a gap like this, the government and the Fed will pursue expansionary policies. Expansionary policies. Now, what are expansionary policies? Policies designed to increase aggregate demand. So what will the government do? What will the government do? And what will the Fed do? Could somebody quickly tell me what these two parties will do? Right? What does the government control? Come on. We're at the end of this course now. Something should have stuck by now. The interest rate? No, the interest rate is controlled by monetary policy. That's in the domain of the Fed. The government's in charge of, when I say government, I mean the executive branch of government and Congress. They make decisions about government spending and taxation. Is that correct? So fiscal policy is about government spending and taxation. And that is what the government controls. So the government is going to cut taxes and increase its spending. That's expansionary fiscal policy. By cutting taxes, you and I will have more income to spend, to shop with. Right? So we'll go shopping more, the AD curve will shift to the right. If the government raises its spending, well, that by itself will cause the AD curve to shift to the right, because government spending is a part of AD. However, remember also that an increase in government spending will trigger an increase in consumption spending because of the multiplier effect. Right? Money spent by FDR on highway construction in the 1930s led to the paychecks of these workers going up, and they then spent the MPC part of their paychecks on meat from the butcher, etc. Remember that story? So this is how expansionary fiscal policy works. What about the Fed? What is the Fed going to do? The Fed is going to buy bonds, principally, or lower the RRR, or lower the discount rate, so as to raise the money supply. Because a rise in the money supply, as we know, is going to cause the interest rate to fall, and this causes aggregate demand to increase. Right? So this is what the government and the Fed do. Government's in charge of fiscal policy. Fed's in charge of monetary policy. So as a result of these expansionary policies, the AD curve in the diagram starts to shift rightwards like this. But as the AD curve shifts rightwards, something starts to happen to the equilibrium price level, which we really haven't talked about yet, but you can see quite clearly that this rise in the price level is going to cause, this rise in AD is going to cause the equilibrium price level to rise. Is that right? So the price level used to be P1, let's say, becomes P2, and then further becomes P3, etc. So as we start to bring the economy back to full employment, as we start to reduce the unemployment rate, in other words, this comes at a cost, and the cost is inflation. Right? So as the AD increases, we have inflation. So inflation is the cost of lowering the unemployment rate in the economy. You do know that as the recessionary gap is narrowed, the unemployment rate falls, right? Because when you have a recessionary gap, you have, in addition to the naturally unemployed, you have cyclically unemployed workers. Correct? So as you bring the economy back to full employment, you are employing those cyclically unemployed workers. So the unemployment rate falls all the way back to the natural rate. Right? So what I'm trying to demonstrate to you here is that there is this trade-off between unemployment and inflation. As you reduce unemployment, inflation tends to go up. Correct? Now let's look at this picture slightly differently. Let's say that this here is let's say that this is YF. So the economy was at full employment to begin with, but then you have a big increase in demand, aggregate demand, which takes the economy beyond full employment, and this results in inflation. Correct? Now, to combat inflation, what kind of policies would be necessary? We call them contractionary policies. What is the government going to do? The government should raise taxes, lower spending. What is the Fed going to do? The Fed is going to reduce the money supply so that the interest rate rises, so that AD falls. So you want to shift the AD curve back leftwards. Correct? But as the AD curve shifts back leftwards, and let's say that you take it all the way back to, let's say we take it all the way back to here. What happens now? We end up with a small recessionary gap. Correct? There is a small recessionary gap now. In other words, the unemployment rate's higher than the natural rate. So we have fought inflation successfully, but this has come at the cost of a rise in the unemployment rate. So the Fed and the government have to tread a fine line between these two objectives. That's the point. Right? There is a trade-off between these two objectives. Right? Now, currently, what's the unemployment rate in our economy? Remember, the Bureau of Labor Statistics publishes the unemployment rate by month, right? So we probably have an unemployment rate for the last month, March. Can we look it up? March unemployment rate. 5.5%. See that there? .5%. Is that in the vicinity of the natural rate, do you think? It is, right? The natural rate is believed to be about 4%, between 4 and 5%. Some people say 4 to 6%. Right? So, in a sense, we're almost at full employment now. Hence, just a short while ago, the Fed announced that it was going to stop its policy of buying securities from banks. This policy that it began in the time of the Great Recession. The Fed decided to stop doing this. In other words, the Fed is no longer now increasing the money supply as rapidly as it did in the past. Now, does anyone have a sense of what interest rates are like now these days? Still very low, right? Why are they so low? Again, think of the money market diagram. Because the money supply was increased to this very high level. When the money supply is increased, the interest rate falls, doesn't it? So because the Fed has been all this time buying securities from banks, increasing the money supply, this led to historically low interest rates. So why has the Fed stopped doing this now? Because the Fed is now no longer concerned about unemployment, the unemployment rate being quite low. Instead, the Fed is now beginning to eye inflation. You see? Because that easy monetary policy the Fed has been pursuing has caused interest rates to be so low that consumption and investment spending have now risen to very high levels. Right? And we know that when AD is very high, that causes, or when the AD curve shifts to the right, that causes the equilibrium price level to rise. So inflation is now the Fed's worry. It's not quite a worry yet, but the Fed is beginning to eye inflation. Right? And we will stop here today.